What if the reliable dividend checks you've counted on for years suddenly started to feel uncertain? More like occasional IOUs than dependable income. For decades, retirees leaned on blue-chip dividend stocks as the bedrock of their portfolios. The idea was simple. Companies with long histories of paying cash to shareholders would fund your golden years quarter after quarter without you breaking a sweat. But today, that bedrock is showing cracks. Rising interest rates have made bonds and short-term treasuries more attractive. Dividend cuts are happening faster than you can react, and tax rules around qualified payouts are growing more complicated. Imagine budgeting for a specific amount every month, only to discover that amount has been quietly slashed by a board vote, or that you owe surprising taxes on what you thought was friendly income. No one warns you that dividend cuts often come with stock price declines, forcing you to choose between selling shares at a loss or facing a dwindling bank balance. And as markets gyrate wildly, those hefty yields you once chased can evaporate faster than the market commentary tells you to hold on. In this video, we're peeling back the curtain on why so many retirees are walking away from dividend stocks and showing you the unexpected alternatives they're turning to instead. You'll hear stories of folks who swapped long-held utilities for short-term T-bills that now pay as much or more without the day-to-day worry. You'll learn how bond ladders and income ETFs are becoming the new go-to for predictable cash flow, and why niche plays like preferred shares or real estate vehicles are tempting those who still crave a yield boost. Stick around, because by the end, you'll understand not just why dividends aren't the safe haven you thought, but how you can build a more flexible, transparent income plan that truly fits today's market and gives you back control of your retirement. Dividend yields once felt bulletproof, steady checks from stalwart companies that formed the backbone of any retiree's income plan. But those days are fading fast. As interest rates climb, what used to be an irresistible 3% or 4% yield on your favorite utility or consumer stock has to compete with virtually risk-free alternatives paying the same or more. Suddenly, the safe yield you banked on starts to look less like a windfall and more like a siren song leading you into outdated assumptions. And when markets wobble, boards aren't shy about cutting or suspending dividends to protect their balance sheets. Think back to the shock in 2020 when once reliable firms slashed payouts as cash dried up overnight. Retirees who felt secure watched their income vanish in a matter of days, leaving them scrambling for replacements at the worst possible time. Even if dividends hold, there's a hidden risk. Many companies now rely more on debt than on profits to sustain payouts, creating a precarious structure that could topple if borrowing costs rise again. You might believe that a company with decades of history won't let you down, but the truth is that no track record is immune to changing economic realities. And don't forget about payout ratios. When they creep above 80% of earnings, the math simply doesn't add up, and cuts become inevitable. What once felt like an impenetrable fortress of income can turn into a crumbling wall, and the higher the yield, the more dangerous the fall. That lure of high income starts to warp your decision-making. You hesitate to look beyond your trusted names, even as their fundamentals deteriorate. The more you lean on those old high-yield plays, the more you lock yourself into an income stream that may not materialize, or worse, one that evaporates just when you need it most. And that's why retirees across the board are waking up to a simple fact. Chasing dividend yield without respect for yield quality is a recipe for disappointment and potentially a hollowed-out bank account when the next downturn hits. Dividend income might feel like a safety net, but it's one that can unravel in a downturn. When markets sell off, share prices plunge, and as a retiree who relies on dividends, that double hit can be devastating. In 2022, for instance, many income-focused portfolios fell into negative territory as energy prices collapsed and interest rates surged. Retirees who needed their quarterly checks found not only that payouts shrank, but that the shares they held to generate those dividends were worth significantly less. Suddenly, the cushion they thought they had was gone, and they faced a brutal choice. Sell shares at depressed prices to make ends meet, or cut spending back to levels they never planned for. It's a volatility trap few retirees knew existed, because the assumption was that dividend stocks would cushion blows rather than deliver them. In reality, when a board cuts its payout, often as a defensive move in bad times, the stock price usually follows suit. That means your income and your capital both evaporate in tandem. Worse, recovering from that double loss is a slow, painful climb. Even if the market regains its footing, retirees may hesitate to redeploy into the same names for fear of a repeat performance, leaving cash on the sidelines and missing the rebound. And the emotional toll can't be ignored. The stress of watching portfolios dip below critical income thresholds, of recalculating budgets on the fly, and of feeling betrayed by companies you trusted can weigh heavily. It's why a growing number of retirees are moving away from pure dividend strategies, recognizing that a strategy promising both income and safety may deliver neither exactly when it's needed most. Instead, they're searching for income solutions that separate yield from share price risk so that downturns don't translate into personal financial crises. Not all dividends are created equal when the IRS comes knocking, and retirees often learn that lesson the hard way. Qualified dividends carry a lower tax rate, 0%, 15%, or 20% depending on your bracket, but non-qualified payouts, like those from real estate investment trusts or certain foreign companies, get taxed as ordinary income. Imagine budgeting your retirement around a steady stream of 3% yields, only to find half of it being taxed at your top income rate, leaving you with far less cash than you expected. Then there's the surprise of K-1 statements from master limited partnerships or business development companies, documents nobody warns you about until tax season arrives. These K-1s can show income from multiple sources, some taxable, some not, and they often arrive in March or April, long after you've filed an extension. Suddenly, you're owing thousands on phantom income you never even received in cash. Even worse, missing that K-1 window can incur penalties for late filing. Suddenly, your safe dividend portfolio feels like a tangle of forms and surprise liabilities. And let's not forget that high payout ratio stocks sometimes distribute capital gains, triggering extra taxes when you least expect it. A blue-chip stock that declares a special dividend might look like extra income, but that windfall can land you in a higher bracket, ratcheting up your tax rate across the board. For retirees who thought they had predictable tax-friendly income, these hidden complications can cascade into a painful jolt, a lump sum tax bill that wipes out months of dividend checks and forces budget cuts. That's why more retirees are leaving pure dividend plays behind, opting instead for income sources with simpler, more transparent tax treatment. A move that keeps their finances smooth and their April surprises to a minimum. But there's an even more controlled alternative waiting in the wings. Short-term Treasuries and T-bills are quietly becoming the new overnight sensation among retirees, and for good reason. These government-backed securities are essentially the opposite of dividend stocks. Instead of waiting on a board's decision, you know exactly what yield you'll get and when you'll receive it. In a world where 3-month and 6-month bills now pay rates that rival or even exceed many dividend yields, the appeal is undeniable. Imagine buying a T-bill at par today, holding it for just 3 months, and cashing out with built-in interest that's locked in from day one. No market risk, no surprise cuts, no waiting on corporate earnings. It's the pure definition of certainty. And because these securities mature so quickly, you can roll them over at prevailing rates, constantly capturing the highest yields without tying up your money for years. That flexibility means you're not at the mercy of a board meeting or a sector downturn. You're in control. Retirees tell stories of parking sizable portions of their nest egg in a laddered series of short-term bills and rolling each tranche forward, creating a predictable cash flow that far outpaced their old dividend portfolio without the share price swings. Yes, the yields might fluctuate as the Fed pivots, but because of the short maturities, you can adapt on the fly, moving into higher rates almost immediately when they rise or locking in new levels before they fall back. And unlike CDs, which sometimes impose early withdrawal penalties, T-bills can be sold in the secondary market with minimal friction if you need liquidity. For many, that combination of safety, transparency, and agility has proven more valuable than the promise of yield alone. It's a reminder that in today's environment, income doesn't have to come at the cost of vulnerability, and that sometimes the simplest tool on the shelf is the one that best preserves both your capital and your peace of mind. Income funds and bond ladders are rapidly becoming the go-to play for retirees who want reliable cash flow without the roller coaster ride of dividend equities. Instead of relying on boards and corporate earnings calls, you're buying into a structure designed to pay you on a schedule you control. With a bond ladder, you purchase a series of bonds or bond funds that mature at staggered intervals, say every 6 months or every year, so that as each run comes due, you receive your principal back plus interest, which you can then reinvest at current rates. This approach smooths out reinvestment risk because you're not locking all your money into a single long-term rate. You can capture high yields when rates peak and avoid getting stuck at low rates if they fall. The predictability is a game changer. Instead of guessing whether the next dividend cut is coming, you know exactly how much cash will hit your account and when. Income ETFs and closed-end funds have tapped into this demand by bundling thousands of bonds, corporate, municipal, even Treasury, providing diversification that's hard to achieve on your own. Many of these funds distribute monthly or quarterly, combining interest income with a small overlay of capital preservation strategies like hedging rate moves or holding cash buffers to smooth payouts. And because they trade like stocks, you can buy and sell at any time without waiting for maturities, making them more liquid than individual bonds. Retirees who've shifted 30 to 50% of their dividend portfolios into a mix of a 5 or 7 year ladder and a core income fund often report far less volatility, more consistent distributions, and an easier time planning their budgets down to the dollar. Sure, you give up the fantasy of a double-digit yield from riskier sectors, but you gain something more valuable, peace of mind. When you know exactly what you'll receive in interest every month, you don't have to chase yield or worry about boardroom decisions. In a retirement defined by certainty over speculation, income funds and bond ladders are quietly proving themselves as the anchor many retirees wish they'd found sooner. Preferred shares, master limited partnerships, and real estate investment trusts might sound like exotic corners of the market, but for retirees hunting yield, they're becoming household names. And for good reason. Take preferred shares. They sit above common stock in the capital structure, so companies must pay their dividends before they pay regular shareholders. That often translates into higher yields. Think 5% to 7%, with less price volatility than common stocks. But there's a catch. Preferred dividends can be suspended without the legal obligation to catch up, and in a rate hiking cycle, their fixed rates lose ground, causing share prices to fall. Next up, master limited partnerships, or MLPs, historically in energy infrastructure like pipelines. MLP distributions often surpass 7%, and the business model, fee-based tolls on energy flows, can provide steady cash even when commodity prices wobble. The downside? You'll receive a K-1 tax form that can complicate your return, and MLPs carry higher credit risk if companies take on too much debt. And then there are REITs, which let you own slices of real estate, apartments, offices, warehouses, without ever touching a property. They must pay out at least 90% of taxable income, so yields can soar into the high single digits. But recessions can hit rents and occupancy, trimming payouts just when you need them. And because REIT shares trade like stocks, they remain sensitive to broader market swings. What ties all three together is their niche positioning. They offer yields that traditional dividend stocks can't match, along with diversification benefits that pure equity or bond portfolios may lack. Retirees moving into these vehicles say it feels like tilting the odds in their favor, so long as they stay aware of each sector's quirks and maintain a small allocation to cover risks. Yet, even these high-yield plays aren't the final stop for everyone. It all circles back to one fundamental shift that's quietly reshaping retirement income strategies. The movement away from dividend stocks isn't just about chasing yield, it's about reclaiming control over your income and your life. Today's retirees are adopting what you might call a flexibility-first mindset, building income portfolios that can bend, adapt, and pivot on a moment's notice. Instead of waiting on a board to declare a payout, they keep cash cushions in short-term treasuries they can roll into any new opportunity. They ladder bonds so that as each rung matures, they can decide whether to lock in a new rate, redeploy into a specialized sector, or hold dry powder for emergencies. Even niche vehicles like preferred shares or REITs serve as tactical tools rather than cornerstones, small slices of a broader, balanced plan that prioritizes consistency over maximum yield. This shift is emotional as much as it is financial. Retirees describe a profound relief once they stop watching dividend declarations and start monitoring their own cash flows. They swap the anxiety of market swings for the satisfaction of knowing exactly when and how much money will hit their accounts. That clarity translates into better decisions. More confident spending, easier legacy planning, and a willingness to embrace new income streams as markets evolve. It also means ditching the outdated idea that passive means set and forget. True passive income today is active in setup, carefully laddered, diversified, and stress-tested against multiple scenarios. By making flexibility their North Star, retirees aren't settling for the highest possible yield. They're choosing the most reliable pathway to meet their needs. And in a world where economic headwinds can shift overnight, that may be the most powerful dividend of all. The knowledge that your plan can withstand whatever comes next, keeping your retirement secure, adaptable, and entirely under your control. Retirement income used to be a simple formula. Pick a basket of blue-chip dividend payers, pocket the quarterly checks, and let the rest of your portfolio handle growth. But that formula is cracking under today's realities. Rising rates have made bonds and T-bills deliver yields that rival or even outpace traditional dividend stocks without the downside of price swings or surprise cuts. When markets tumble, dividends get slashed and share prices fall in tandem, leaving many retirees scrambling to preserve both income and capital. On top of that, tax complexities from non-qualified payouts to phantom K1 income can turn predictable dividends into April nightmares. It's no wonder so many are shifting toward income funds, bond ladders, and short-term government securities that lock in yields and schedule payments on a timeline they control. Even niche options like preferred shares, MLPs, and REITs serve as tactical slices rather than portfolio cornerstones, offering higher distributions with known risks and tax treatments. What ties all of these moves together isn't a blind chase for the highest percentage, but a strategic embrace of flexibility. Today's retirees talk about the relief of knowing exactly when money will land in their accounts. No vote-by-board guesswork required. They swap the anxiety of missing a dividend announcement for the confidence of a maturing bond or a T-bill that delivers a guaranteed return. That mindset shift from dividends forever to flexibility first may be the most important development in retirement planning over the past decade. Because income isn't just about yield, it's about reliability, transparency, and control. If your retirement plan still leans heavily on dividend aristocrats, consider whether you're chasing yesterday's safety when today's certainty is sitting a few clicks away. In the end, the real dividend you want is peace of mind, an income strategy you can trust come market rally or downturn.